Hey, good morning, guys. Lots of tariff wars are going on in this globe right now, and we can expect to see a new all-time high in safe haven. So, in this video, we're gonna break down gold using multi-time frame approach. As always, we will start with the higher time frames like monthly, weekly to build the directional bias, and then we will drop down to the daily chart to see where we can actually position ourselves, and then we will drop down to the intraday chart like 4 hour and 1 hour to fine tune our position. Perfect. So let's get started. Starting from the monthly time frame, this is the last resistance that broke above, closed above, turned into resistance. Price retested this level and then showed us a really strong impulse. And if we drop off Fibonacci on this impulsive move, after completing this impulsive move, price corrected back all the way to 38.2 perfectly, kissed this level, and right now we're trying to make a new higher high. Another interesting thing that I can notice is that this is the candle of like April 25, and price is stuck inside this candle range from last 1 2 3 4 months. We only have 18 days left for this monthly candle to close. So the key question for this whole analysis is that can we expect price to show us a new all-time high? Dropping down into the weekly time frame, this is the last resistance that turned support. After completing this impulse, price corrected back all the way lower, and if we drop off Fibonacci on this impulsive move, this area is perfectly lining up with 61.8, and after rejecting from this level, price is now trying to make a new higher high. So we are targeting towards this high. If we zoom in a little and see what is our actual weekly bias, this weekly candle was very strongly bullish after clearing this internal range sell side liquidities. Price strongly pushed above, and the last week was pretty bullish too. And right now, as soon as the new weekly candle opened, price is strongly trading towards downside. It's already Monday, okay, and it already completed almost 80% of the range of the last week. But still, the weekly bias is towards previous weekly high because this formation is giving us the exact bias towards upside, and we are also above like fast moving average like 1020. Let's check if it is or not. Yeah, we are also above fast moving average 1020, so we can actually target towards this high. So let's see what's going on into the daily perspective. Into the daily perspective, if we drop off Fibonacci on this impulsive move, the 38.2% is somewhere around here. So we can expect price to drop a little more downside before starting the upside momentum, but at the same time, this area seems like a pretty strong and interesting area of resistance that turn into support. So let's drop down into the 4 hour chart and see what's going on over here. Okay, this is the level where price can trade towards. If we drop off Fibonacci on this impulsive move, we're currently below 78.6. So what is my views on this one? How I'm gonna trade this? If you want to take any aggressive position, I'm gonna place a aggressive position with a like conservative risk, risking around 0.25, 0.3, and I will wait for a with a stop below this level, and I will wait for a structural shift, intraday structural shift into 1 hour time frame maybe, and then I will position myself for a long trade and target towards this high, previous weekly high, and if possible I will try to hold my remaining position towards this high. Okay, if I close some partials over here, I will hold the rest of the positions towards this high. One interesting red flag for this whole idea is that price is actually rejecting from 78.6 of this impulsive move, which actually created a breakout structure. So that's a big red flag for us. But still, as the overall HDF bias is bullish, we are actually targeting towards this high. So that's my views on gold. And if you find this video helpful, please drop a like, comment down your views on gold on the comment section below, and I will see you soon on the next analysis session. Thank you.